Good morning, this is Nick Stern. I'm a certified financial planner here at Robert L. Stern Financial Services. Thanks for tuning in. It's nice to see you again. Happy Memorial Day. We are off to hopefully a very good summer, and I hope the same for you. So jumping right into our topic discussion for this month is trading versus investing. I'm going to preface the video that it's important over anything else that your goals and objectives, as well as your overall financial picture, play the biggest role in what you do from a financial investment standpoint. That is just critical. It has to align, or else it's going to be more challenging to make the right decisions for yourself. So, trading versus investing. In short, I would define, and this is my own definition, I would define trading as day-to-day, short-term. Short-term is under a year. It's typically more from week to week, even day to day, and you're going to be looking to move in and out of positions on a very frequent basis. Investing is a longer term approach. So in order to, for example, have a long-term investment tax-wise, you have to hold an investment for a year and a day in a taxable account. That, of course, is not applicable to IRA or individual retirement accounts. But you're really taking at least 12 to 18 months. Really beyond that, though, from an investment standpoint. Just as an example, Warren Buffett, probably the most successful investor ever, based on what he had to start with and what he has now, takes an extreme long-term approach. 5, 10 years. We're talking a very long-term approach to his investment process, and it has netted him significant gains. Anyway, I really want to focus on trading. There's a lot of noise, articles, social media posts. It's everywhere. Trading, 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 trading. So again, I define trading as very short-term trades to looking to make small profits that equate to bigger profits when you add them all up together. So I'll first say that the advantage of trading is you can potentially make more profit more quickly. I really want to underline twice and bold and capitalize potentially. It's very important. I would say that's probably the only real advantage to doing trading. I would say the major disadvantages of significant trade costs, tax inefficiency, and in order to time the market, it's difficult to do it consistently and successfully over a long period of time. I know that's sort of counterintuitive, but trading, you're looking to make trades over a short period of time to trying to make more profit in a quicker time frame. But if you're trading, you're doing it over a long period of time. It's very, very, very challenging, in my opinion, to be successfully and continuously in trading. There are a ton of social media posts out there, or people or coaches that are claiming that they, more or less, I would say that they make it look easy, and you can hire them and they'll teach you to be just a master trader in a short period of time, and then you're good. I would urge you to do significant research and significant due diligence into those before you buy into that story, because it's not easy. The people that are doing it, it's a 24/7 job. At least that's in my opinion. I would say that you really shouldn't dabble when you trade, meaning that you're going to just do it in your spare time. If you want to be successful at it, again, I would say that it's a 24/7 all-the-time job. You have to be on all the time. And if you have a day job, it becomes even more challenging because the traders that are doing it are watching the markets 24/7 from open to close. And then they're watching it after hours, because the idea behind it is you're looking to make small profits, or large profits for that matter, in between the day and different trades, and trying to do it over and over and over again, and timing that says, okay, well, it went up 1%, I'm going to trade. And not everybody's like that. I'm of course generalizing, but to time the market, you have to be right twice. So let's take a downturn, for example. The market is starting to go down. You sell out all of your money, and let's say that you took a very small loss. Well, then the next couple hours or days go by, whatever time frame you want, and the market continues to go down. So you're feeling pretty good about it. So you got the first piece of the timing right. The real challenge in that is, well, when do you get back in? Because as soon as you can get back in or wait, the market can flip quicker than you can get back in. And either one, you defeated the purpose of what you're trying to do, or two, if you get back in too late, that means that you actually bought higher than what you sold at, so then you really lost some money. So it's important that you think about that when you're looking to trade. Also, I would say that if you subscribe to television shows that may tout various individual securities, I won't mention any names, Kramer, it's going to be, you really want to do your own research and due diligence when you're looking at that. And also read the disclosures, because he or other people could be saying that they recommend an individual security, but they most likely have stake in whatever they're recommending. So if you're betting with them, so to speak, it may or may not work out for you. And also, you have to consider that they have no idea what your financial picture is. They have no idea what your risk tolerance is. That's why it's really important that you have a very, very good understanding of what those things are, because those recommendations could have an extremely high risk to them. And you might not be a very risky or a risk-oriented investor. So, because if you have a retirement plan at work and it keeps you up at night, and if your account fluctuates $10 to the downside, then watching those shows are probably not for you. I can't say that with certainty, of course, because I don't know you, I don't know your personal situation, but that's why it's important that you do. And oftentimes, those recommendations can be, in fact, a trade, and there is a big element of timing that goes into it that's very important. And if you miss that timing at all, it could be very impactful to you, generally to the downside. So that's why I would just recommend you really, truly do your own due diligence and research before you buy into anything, particularly when it comes to trading, and particularly when you see somebody being interviewed on a certain network that is saying one thing or another. Oftentimes, like I said, in the disclosures, whatever they're saying, they will profit if they get it right. So make sure that you know that. Anyway, back to trading. Another disadvantage of trading, particularly if you're in a taxable account, is in order to get favorable tax rates, you have to hold an investment for 1 year and a day. Depending on the tax bracket, if you're in a medium tax bracket, anything above the 15%, it's meaning in ordinary income tax rates for 2017, so let's say you're in the 25% tax bracket, a long-term capital gain would be taxed at the 15% tax rate. If you're in the two highest marginal ordinary income tax brackets, it's 20%. If you're in the bottom two marginal income tax brackets, it's 0%. So if you're in that medium range of a tax bracket, 15% is still 15%, but it's a lot lower most likely than your ordinary income tax bracket. Versus if you even hold the investment for 1 year and not that day, the gain, if you have one, will be taxed at ordinary income tax levels. So my example is, if you're making consistent trades, and let's say you are making consistent profits, but you're trading within a couple months or a couple days, those profits are going to be taxed at ordinary income tax levels. So you have to factor that into your bottom line. In addition, trade costs factor into that as well. So when you're talking to somebody who's really successful at trading and they're telling you how much money they made, if they don't want to tell you, which they probably won't, but just one, make sure that you assess all the costs that would be associated with it. And two, they definitely have losses too. Don't let anybody tell you that they've never had a loss. And three, taxes eat into the bottom line. So overall, probably between trade costs and taxes, I would say, generally speaking, at least a third of their top line is being reduced. That doesn't include any potential losses and anything that gets retied up into other investments. So again, trading, a couple key takeaways. One, anybody that you're listening to, do your own research, do your own due diligence, have a very good handle on who you are financially, how you feel about risk. Two, factor in all the different costs and expenses associated with trading. Three, if you have a day job and it's not something that you can do all the time, it is, in my opinion, that trading or dabbling in trading, it is just all that much harder to be successful consistently. Switching to investing. Investing, as I had mentioned before with Warren Buffett, is really more of a long-term deal. It also factors in, most likely, a different type of research than trading. Trading is more technical analysis, which we briefly talked about last month. Technical analysis goes over charts, current information, price action, 50-day moving average, 250-day moving average, etc. Whatever you want to use as your factors when you're charting and looking at that, that goes into it. With investing, technical analysis definitely has its place. Fundamental analysis definitely has its place. I would say, in my opinion, the use of both, and there's no guarantees. There's nothing that's right, wrong, or there's lots of successful people and investors on both sides. But I would say the most successful probably use both. Fundamental investing factors in the story of the company, the balance sheet, cash flows, valuation, a number of different elements that would help you assess whether or not the company or security or investment is in fact an investment that could potentially net you profit based on your risk tolerance and financial picture, etc. So the use of both, in addition to you're taking a longer term approach, I would say will enable you or allow for a potentially higher probability of success because you're taking a longer term approach. You're not looking to make X amount in a day or a week or a month. You're saying, I like this company, I like this story, and the balance sheet is solid, and I'm gonna invest in this, and my timeline is at least 12 months. It's 18 months. I'm not gonna look at this for X amount. And it doesn't have to be a retirement account. It can be a taxable account, and you can still take a long-term approach. Also, too, short-term volatility, while it does fluctuate the account, can play less of a role in your overall end result because you're not basing your decisions off the immediate. You're saying, I believe that this is going to appreciate in a longer time frame that can play a better role in success. And again, underline can, potentially, etc. So if you have any questions, please let me know. The key takeaways of this is it's very important. I know there's a lot of hype behind trading, but think about this and whether or not, I mean, if you want to do the trading thing, that's great, but just do your own research. I would recommend not dabbling in it. Go full in and think about all the various factors that go into being successful as a trader. If you want to subscribe to my channel, right up here. If you'd like to take a look at our website for more information, right down here. And if you want to look at last month's video, right here. So again, thanks for tuning in. Really appreciate the time. I hope you have a good start to summer, and I will see you next month.